Thank you for joining us here at the FundForum in Monaco. I'm here with Peter Marber, who runs the business strategy, chief business strategist for HSBC. Is that correct? On the emerging market side?
For the global asset management.
Correct, for global asset management. My name is Daniel Enskat. We're both from New York, or we're both sort of half of our time at least in New York, a little bit. You gave a speech earlier today about emerging market or global bonds in the context of emerging markets. And maybe we'll start briefly with HSBC as a group, which is a global group, clearly represented everywhere, but it also has a focus on emerging markets. So if you fill us a little bit in on that, and then we'll jump right into the emerging markets.
Obviously, anybody who travels, has been in an airport, probably has seen some HSBC advertising.
Very true.
It's a local bank. We are in 89 countries, but actually as a corporate strategy, the bank is trying to make large decisions around the big mega trend of globalization. And a lot of the bank's expansion and businesses are out in emerging markets. And that's reflected in our asset management business, where about 1/3 of our assets are actually in emerging markets. That's probably one of the largest totals for any.
Although not everybody knows about that, right?
Because they don't. We have
from
about,
a brand.
I think we have about 430 odd billion US under management, of which about 130 billion is emerging. And actually, emerging market debt is more than half of that. And so we really believe this is an important asset class. It's certainly an important asset class for us. And just in general, people are underrepresented in emerging markets.
That's been a theme this morning as well, sort of the underappreciation of emerging markets in general, or then institutional investors not quite being enough in emerging markets. Now, when you think of, since the crisis, a lot of the flows have gone to fixed income strategies, a lot of that to global fixed income strategies. How do you see sort of the global bond space versus the emerging market bond space?
Well, in general, when you look at a global bond product, most of them are following indexes that are 95% US dollar, euro, yen, and sterling. Mm-hmm. And the 5% extra is normally a little Aussie dollar, a little C dollar. Very little, if any, isn't going to be in emerging markets. You'd have to go to an emerging market bond fund to get emerging market exposure. And we tell everybody that that's unfortunate, because when you go into those global bond funds right now that are following these indexes, most of the currencies are somewhat overvalued, and most of the interest rates are actually below inflation. So you're getting like a negative yield. So the long-term exposures that people have in those aren't going to lead to very good returns over the next 10 years.
Well, I guess if you look at then some of the flagship funds, I mean, everybody here in the industry heard about, PIMCO's, Bill Gross's fund on the global total return side, or Franklin Templeton's global bond fund, who of course is managed by Michael Hasenstab, who says, I don't have G3 exposure at all, it's mostly in emerging markets. And that is one of the funds that has gotten billions and billions in cash flow. So is there, I guess there are some very strong global bond funds that do have a lot of emerging markets?
I would say it's very few, and mostly what they've done is use it tactically, meaning they're going to go in when they think it's a risk-on environment, they'll take it when it's a risk-off. But the reality is that investors should have a structural allocation to this space. It's a really interesting asset class that for the last 12 years has actually been the best performing asset class in the world, with relatively modest volatility. And in fact, I was just looking at a chart. It wouldn't have mattered what day you bought emerging market debt over the last 12 odd years. It could have been the day before Lehman Brothers collapsed. If you would just hold your position for 16 months, you would have never lost any money, meaning the market has been that resilient in terms of rebounding. And
how much is an average exposure then that you see with your clients to the asset class?
Well, interestingly enough, you'll get maybe a 2 or 3% institutional allocation. Mm-hmm. But actually, why would you allocate 2 or 3% if you're a big institution? It could not contribute that much. We're trying to recommend people in their bond portfolios actually look more like to the 10 to 20% range. As I showed in my charts today, trying to substitute about 20% of global exposure with emerging. Very few institutions or individuals are doing it, but you can make a really compelling argument that right now, given where credit spreads are and relatively undervalued currencies in emerging market, it's a good place to be.
Now, is that, if you think about that kind of allocation, how much education does the asset management industry have to do to get to get clients there, to get to 5, 10, 15. We actually saw a couple of panels this morning where people said we want to have 25+% allocation to emerging markets as not a tactical but a more strategic issue. What does it take?
It takes an enormous amount of education because, as we said, that particularly the last 5 years, a lot of people have lost confidence in their overall asset allocation skills because I think people have looked back on huge structural bets made on equities in the major markets and they've delivered very little return now for a very long period of time. And so it's very tough to kind of get their heads out of old mindsets.
Right.
But in general, what we try to recommend to people is that, look, forget about doing it all on day one. You know that in about 10 years you should have a certain amount of exposure. So if you're starting today with 0 in emerging and you want to have 20 or 30% in 10 years, well, every year add 2 or 3%. And
so dollar cost averaging in an institutional setting.
Because it's a structural reason to be in. It's not a tactical reason. We really believe that this is the new global, that over the next 10 years, indexes will probably be redefined and recomposed that have a lot more emerging countries in them.
Well, if you look at it, though, also, I guess 2 last points that we can touch on. One is, from an asset class perspective, the asset in emerging markets are mostly still on the equity side. In a couple of trillion, and fixed income is still a smaller component of that. But then, and the flows before 2008 were mostly to equity funds, but now you see more and more emerging market fixed income product, local currency debt fund, etc., becoming important not only on an aggregate basis, but you see these flagship funds that are raising multi-billion dollars in assets. So do you think there's an inflection point here that people are realizing that slowly?
I think so. I mean, it's getting... Emerging market bond funds are certainly getting a boost from U.S., European monetary policy. By pushing interest rates so low, they're forcing people to look for other alternatives. It's unfortunate, too, because most people, they believe the long-term story in emerging markets. They believe in the convergence. They believe in the growth story. But they have believed also that they should be capturing that through equities. Yeah. And statistically, there's very little correlation between a country's growth and the returns you get in their stock markets. And we know plenty of investors who've been literally in emerging stocks for 20+ years but don't own anything in emerging market bonds. And it's unfortunate because we say that the long-term growth in emerging markets, if countries really do trade, keep their inflation low, and integrate globally, you will see their currencies appreciate and you'll see their credit risk premiums decline, meaning that the debt markets actually capture the growth story far better than the equity.
Do you see a way now, we see more balanced emerging market products, so that equity bond being put together is sort of a solution for emerging markets? Is that sort of an interim step to get there?
I think so. I think that people still see the higher volatility in emerging market bonds relative to their home market bias bonds, and everybody does have a home market bias. So they clearly have to take more risk to go out of the home market. And I think people are looking at the volatility in emerging market debt and saying, hey, it's probably somewhere between bonds and our traditional equity. Yeah. So maybe it is something of an intermediary step.
And last question, if you look now at the European crisis, all the discussion of where the euro is going to go, the US sort of debt issues and election cycle, the Middle East Arab uprising, and then sort of the discussions of now BRIC are not really pulling their weight anymore. You have some issues in Brazil, in India, etc. China's not growing as fast. How do you see that balance? Because we've seen in the 2008 crisis that emerging markets actually were helping the recovery. Right. Where's that going?
It's an interesting question. I think that clearly we're seeing a slowdown. We've seen a slowdown in Brazil, China, India, the major growth engines in emerging markets. And obviously we're having below trend growth in the U.S., Eurozone, Japan, places like that. So what we tend to believe is that on the fixed income side, emerging market debt is probably the most interesting place to be because we don't know whether we're going to punch out into some great growth spurt anytime soon. So emerging market bonds are probably the interesting place to be in the bond space. But believe it or not, if it is a more difficult economic environment, actually it might be to the advantage of, let's say, American and European companies who have had to navigate tough waters before, whereas emerging market companies, they've had the wind behind their sails for the better part of the last 15 years. And so many of these companies are untested. It's going to be interesting to see whether they can stay profitable in slower growth economies.
Interesting. So they're a competitive field, West-East, or developed versus growth.
This is why investors really need to start thinking globally about bonds and stocks, meaning you should be interchanging all of this stuff on a much more fluid basis than just these sort of like getting an idea in your head. Oh yeah, emerging markets. It's time to do a little bit there. You should really just look at the global economy and realize that these countries are now about 50% of the output, and they should command a bigger piece of your portfolio.
Well, that's what we have an Emerging Market Summit today. Peter Marber, thank you for joining us here, and thanks for watching the FundForum International 2012 interview series.